And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Wednesday, it's Fed Day, and of course, all eyes are on the focus of the Fed today. Will they, won't they, what will they say, all that. The reality is that yes, they're going to cut rates today by 25 basis points. They'll say that they're going to be more data dependent going forward, which is just kind of Fed speak for, well, we might not do a rate cut every meeting next year. We'll kind of see how the data goes. But again, the push is going to be to lower interest rates, as we've talked about before. The Fed funds rate, which as of today, when they cut rates today, the average Fed funds rate will be about 4.33, splitting the 4.25 and the 4.5 rate that calculates the Fed high and low range. That is significantly higher than the rate of inflation. So interest rates still need to come down next year. Markets are anticipating about a 3% Fed funds rate next year, which would align with inflation, right? That's where it should be. If rates are too far above inflation, you have restrictive monetary policy, and that potentially hinders the economy. So got a few of those things going on. But that's going to be the big conversation today. All eyes are really going to be focused not on the actual announcement itself, but on the presser after the meeting today. Of course, also the Fed releases their economic projections going forward, their dot plot, so to speak. We'll see that as well about what their expectations are for economic growth, short-term, long-term, inflation, of course, and also kind of the direction of rates. So that'll all be in that data today. Mike and I'll have plenty of talk about with you tomorrow, and we'll see how the market reacts to this today. But, you know, futures are up this morning. S&P's up about 30 points. Dow's up about 123. NASDAQ's up about 64. So it'll be a nice opening today coming out of the gate, at least. We'll see whether or not the market can sustain that. And really what happens this morning in the market won't matter because it'll all change depending on what the Fed says this afternoon. So we could either see a really big rally this afternoon or a decent sell-off, depending on kind of what the Fed says. But again, you know, just kind of we're in that period of the year. We've been talking about this for the last couple of weeks. So this sloppy kind of trading action that we have, we'll talk about that in a minute, continues as we go through this portfolio rebalancing. And you know, this is something that's interesting right now because I'm seeing a lot of headlines out, a lot of conversation. It's like, oh my gosh, NVIDIA's down 10% off the peak. Well, yeah, it should be. We're rebalancing portfolios. This is that time of the year. I'm going to sell some of my big, you know, NVIDIA's had a huge run this year as an example. It's up well over 120% this year. So if it was supposed to be 2% weight in my portfolio, it's now 3 or 3.5% of my portfolio. So I've got to reduce that back to 2. So yeah, you're going to get some selling in stocks like that. Alternatively, you're going to see buying in other stocks that, you know, have been underweight in portfolios, need to be brought up to weight. You're also seeing some real kind of interesting repositioning in portfolios this year. Expectations going into next year on healthcare, energy, materials, those have all been under a lot of pressure here as these portfolios get rebalanced and reweighted for next year as well. So again, you know, a lot of this volatility that you're seeing in stock prices is just a function of all these mutual fund distributions, rebalancing, tax loss harvesting, all that, right? That's all that's going on here. So don't start making long-term economic decisions based on this 2 weeks of the year because this happens every year. And again, it means nothing. What will mean something is what we see after January the 5th. After January the 5th, we're going to see portfolio managers really start to focus their outlook for the year, start making their bets in areas of the market based on what their expectations are for the year. So, but between now and the end of the year, it's all window dressing for reporting. I've got big gains to report this year. I've got to have the right positions, all this. And if I've lagged my benchmark this year, which a lot of mutual fund managers have, ETF managers, professional managers have lagged their benchmark this year, they got some splaining to do, Lucy. So all that's going to show up in the annual report. So again, they've also got to go talk to their boss as to why they didn't perform with the markets this year. So all that's going on right now. So don't read a lot into it. But let's talk about what you need to know before the bell this morning. Market's sitting right on the 20-day moving average, exactly where you would kind of expect it right now. We're kind of holding that level of support, bounced off of it yesterday. This morning, we're going to make a little bit of a push higher. Again, we're just kind of flirting within this trading range, just slightly off of all-time highs. Now, we're still on a sell signal, been kind of working off some of that relative strength overbought condition. There's some more to go here over the next few days. So we could definitely see a bit of a sell-off this afternoon, maybe into Thursday or Friday, particularly if the Fed comes out a little bit more hawkish today. That's okay. That's all would be just kind of part of this setup to get the markets oversold enough to rally into year end. So, again, just as we talked about last week and this week, we said expect volatility. And that's exactly what you've gotten. So, it's just been a really kind of sloppy trading week, and that just is going to occur sometimes. But again, don't get too wrapped up into what's happening right now. There's some reasons this is happening. The trend of the market's been very good. We've had a very, very good year here. So, there's just not much of a reason of overall concern with the market right now, particularly heading into year end. But we kind of went through some other areas of the market yesterday, basic materials, energy, those areas are deeply oversold. Healthcare, the worst performer this year, kind of across the board over concerns about what the new administration may do in terms of healthcare reform, food, all those type of food, medications, etc. So some concerns about that. Now, typically healthcare as a function tends to perform better after the election. So in pre-election year, so last year as we were going into the election, healthcare tends to underperform going into the election because they don't know what the new administration is going to do in regards to healthcare. Healthcare tends to perform better after the election. So if you take a look at healthcare, it is deeply, deeply oversold here. And again, just really kind of across the board has had a very big decline here, really ever since the beginning of December. Lots of selling pressure, but that's been going on all the way back to September. So once it became a little bit more clear back in September that it looked like Trump was going to win the election, and of course with Robert Kennedy kind of taking over Health and Human Services, lots of concerns about what that would mean for insurance, the Affordable Care Act, the FDA, etc., have had a lot of selling pressure going on in healthcare stocks. Those stocks are really, really beaten up. There's going to be some decent opportunities. Not every stock in the sector, just don't go buy the whole sector. But there's going to be a really good opportunity in some of the stocks in the healthcare sector because of that. And as we talked about yesterday, energy is going to be another one. Again, deeply, deeply oversold. We're going to have a fairly decent counter trend rally in energy stocks as well, probably once we get into the new year. So again, it's just, be careful bottom feeding. There's still a lot of pressure for various reasons in this sector, but you're getting oversold enough now that there's going to be some decent bounces in some of these areas like real estate, like staples, like healthcare, like energy that have been deeply, deeply oversold and could see a rotation out of some of the more high flyer stocks that we've seen as of late. But again, just one of those things you want to be cautious of. It's the timing of that move is always the difficult part. So probably, kind of the best way to approach this is just to wait and start to see that recovery and then buy into it once you start to see there's an actual recovery and a flow of funds into those areas. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. We've got to talk about, should you put 100% of your money in stocks going into retirement? New study out about that, and we'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning. Welcome back to the show. Danny Ratliff joining me this morning. Got a few things to talk about. But, they say that God never gives you a challenge that he doesn't think you're up to. Well, every morning I drive to work and from my house, and I take this turn on this kind of back road that cuts between kind of the two main thoroughfares to get to the office. It's kind of this long, straight road that's very, very rarely any traffic on it, so it's an easy way to start to get to work. And there's been this old building right there on the corner. It's been sitting vacant for the last couple of years since I've been kind of in this area. And this morning, a new sign went up for the building. Dunkin' Donuts. So now every morning when I drive to work, I've got to pass Dunkin' Donuts. So I know God's testing me. He's testing my willpower to stay on my diet. But yeah, Dunkin' Donuts.
Well, you take like 2 turns to get here.
Yeah, no, 3.
3, okay.
Yeah, and a U-turn.
And how'd you chip your tooth? You may be in trouble, buddy.
So,
oh, man.
Anyway, how are you this morning?
I'm good.
Good. Awesome.
Good.
So a couple of things. Interesting article out yesterday talking about there's a new study, and it came out and said that investors, retirees basically, should have 100% of their money put in stocks. And that will outperform over time, so you can still take your 4% withdrawals and, all those type of things. And that allocation should be primarily international stocks, which I thought was interesting. Like 60, I think you can quote me on, you can tell me the exact numbers, but I thought it was like 60% international and 40% domestic, stocks on the allocation, something like that. Is that right, Danny?
Yeah. I mean, when you look at this, it's kind of interesting, and it goes to some of the things that we've been talking about recently in the sense of this overly optimistic type of mentality right now. And I've been describing what we feel, I think, and you can correct me if I'm wrong, and your sentiment is we're probably cautiously optimistic. Right. That, there's potential certainly for more upside here, but there's some things that have gotten a little bit out of whack. It would not, surprise us to see more volatility, but this euphoria type of environment is interesting. And, this article comes out once or twice a quarter. And it's, it flip-flops between one or the other. And I need to go back, and if I had more time, I'd go back and see what this person's written, because I guarantee you 6 months ago they were saying that, 60-40 is the new thing. Make sure you're in it. And that's a challenge when, we get this type of information. But, to just totally eschew bonds altogether can be an issue in the sense that, number one, you're going to increase your volatility substantially.
Right.
And I think when people hear this, they think, okay, you know what? Screw it. We're getting out of bonds. And we've had clients who even said the same thing. Look, inflation's sticky. Rates have not come down as quickly as we've expected. The Fed's been cutting interest rates, yet we're watching the 10-year has actually kind of gone back up, and we're seeing that a little bit today. I mean, bond yields are up 10, 11 basis points on the heels of the Fed cutting tomorrow.
Right, and which is not surprising. If you go back historically and look during Fed rate cutting cycles, the 10-year Treasury rate rises during the initial Fed rate cuts, and then it falls to catch up with the rate cuts. So again, where we are with this rate cutting cycle, the 10-year Treasury is doing exactly what you would expect it to do. But you're cutting rates because economic growth is slowing. And again, as we talked about, previously, if you look at, every other country in the world, whether it's China, the UK, Eurozone, Japan, they barely have any economic growth, if any, and they're very borderline recession. We're the only country right now with any bit of economic growth, and that's still coming from all that liquidity that we inject into the system. So everybody's starting to think that the inflation and the economic growth that we have right now is a function of organic activity, and it's not. We're about to get a massive revision to employment. All the employment that we thought we had in 2024 is about to get revised away. There was no employment growth in 2024. So, all of this stuff that we've known for a while is about to come off the books, and we'll see how that works out. But no, inflation is, yes, inflation doesn't go straight down. And when you get into year-over-year comparisons, you're going to get into these little phases where, inflation doesn't go down as fast as you would like it to. Everybody wants inflation to plunge to zero. Well, we need a recession for that. And we're clearly not in a recession. But when we do get in a recession, inflation is going to fall rather rapidly. That's just a function of how that's going to work because it's a supply-demand equation.
Yeah, so those numbers that you were mentioning were actually 67% in international.
There you go, 67%. I knew it was high.
3% in domestic stocks, which, one thing that they didn't show is what is the actual time frame that they utilize for this?
Right.
Or are they just using assumptions for future returns based on valuations? Because the argument that we hear frequently, and you guys hear it too on any mainstream media, is that how cheap international stocks are. And this is where everything's going. But if you follow the bouncing ball from an economic perspective, they're cheap for a reason.
Well, and not only that, they've been saying that
10
for
years.
the last 15 years.
Yeah.
They've been saying, next year is going to be the year of emerging markets. Next year is going to be the international stocks. It's going to take over from domestic because the valuations are cheap. That's been the story for 15 years.
Well, and it's also been over the last several because the dollar's going to decline in value. That hasn't happened. So, any time that, you think from an import-export perspective with the dollar's high, it's a challenge for these other markets.
Right.
And then we see the slowing economies across the globe. That poses other issues in the sense that, okay, so they're cheap, but can they get cheaper? And, by the time, even when we invest overseas, unless you're like in a dollar hedged type of ETF or mutual fund, a lot of times by the time you bring those funds back, you haven't made nearly as much as you would expect.
Exactly. Well, and this is always the big misnomer of this. And again, if I go back in history, right, and this is where a lot of these studies go, they go, okay, well, let's get all the data back from 1950 and, build this allocation of stocks versus bonds. Well, from 1950 to about 2000, there was a non-corollary environment in equities. So in other words, international would go up one day, U.S. would go down one day, and then they would flip-flop back and forth. So they were non-correlated assets. So it made sense, and this is the whole premise of Harry Markowitz and modern portfolio theory, which was have this diversified basket of stocks and investments, real estate, emerging markets, bonds, et cetera. And you had these non-corollary assets. So if one thing went up and one thing went down, there was always kind of a balance in the portfolio. So you got steady growth over time. Well, since 2000, because of the invention of the internet and us doing transactions at the speed of light globally, there's no longer a non-correlation between assets. In fact, most asset classes are now highly correlated. And we're seeing that even today, right? Bitcoin's very correlated to the U.S. stock market. And so you have these all correlated assets. So that whole benefit of non-correlation has now gone away. And Brent, can you bring this chart up for me?
But not only that, if you think about 1950 to 2000, the market was not nearly as intertwined as it is today.
Yeah.
And you think about the large corporations that are here, they're multinational. And so they're already deriving a significant portion of their revenues from overseas. I mean, many of them, if you look at the S&P, what is it, 35, 40% of revenue comes from overseas?
Yeah, no, that's right. And so, but that's the whole point, is that now we're also very correlated. So this chart is the S&P, emerging markets, China, and international, industrialized international, so EFA. So it's just over the last 15 years. And so if I had money invested, 67% of my money invested in international stocks, I would have grossly underperformed the market relative to just being invested in U.S. domestic stocks. So, again, if I'm trying to generate a rate of return, I just added a whole bunch of boat anchor to my portfolio. But more importantly, if you take a look at the chart closely, you're going to see that there was no non-correlation in 2020. International crashed just as much as the U.S. stock market did. So if I had 67% of my stocks international, I had underperformance and I had no crash protection. They didn't go up when the U.S. market went down. Same thing in 2022. They declined just as much, if not more, than the U.S. stock market did in 2022. But unfortunately, they didn't rise nearly as much as the market since 2022. So, again, it's your time frame is very important. And the problem with all of these studies that they come out, they go, okay, well, let's take the data from 1950. Well, you didn't live in 1950 and you didn't start investing in 1950, and this ain't 1950 anymore. So things have changed. And so we need to start looking at how the world operates today and start making those decisions based on your time frame to retirement. And moving into your retirement years at this juncture with valuations now at the second highest level on record, which it doesn't tell you the market's going to crash, but it does tell you your returns are going to be lower in the future. If you take a look at where we're headed economically, where those trends are going to be relative to the rest of the world, and those are very highly correlated. You don't have growth in one country and recession everywhere else in the world. That does not exist ever. So all trends of economic growth are going to trend in the same direction because we're a global economy. So if you take a look at that and say, okay, I want 100% of my money in stocks going to retirement, you may be very disappointed.
Well, you could be very disappointed. I wonder what that chart looks like, though, if you go back to where you see more prolonged periods of a decline in the markets. Like if you look at 2001, 2, and 3, you look at 2008. I mean, what you just showed from a 2020 and 22 perspective, that's kind of an anomaly in the sense of how quickly the market's rebounded. That usually doesn't happen as quick. Now, we do see after really bad years, you typically get good years. But if you stretch that out, what does that look like? Because we know if you invest in the S&P 500 in 2000, never put another dollar in, you didn't have every year that was going down, but it took some time for you to get back to even.
Well, just put it this way. When the U.S. stock market crashed about 50% in 2008, international stocks were down about 70%.
Yeah. That's interesting because what they share here, we can share this on the other side, is the data from a maximal drawdown. Now, what does that do for you? If you're taking distributions, it is much more significant.
Yep. All right, be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Show your love this Christmas by giving a used gift to somebody you love.
Nothing says Merry Christmas like a 2005 big screen TV.
Merry Christmas to you too, you little freak. On a roll this morning. Anyway, I may be divorced by the time I get home. It's better than stimulus.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just to put a bow on, since it's Christmas, just to put a bow on our last conversation, you should probably not put 100% of your money in stocks going into retirement. It's up to you how you manage your own portfolio. I'm not going to tell you what to do, but I probably wouldn't put 100% in stocks, and I probably wouldn't put 67% of it in international. That's just me. Call me crazy, but there you go. But there was a very interesting article in Barron's, Danny, talking about think you can beat the stock market, how to bet on individual stocks and limit risk.
Yeah, and this is always a fun one, right? Especially when markets are going up.
Yeah.
And, we have a lot of clients that trade on their own where, we likely manage the bulk of their funds. They want to manage a little bit because it's kind of play money. And, we encourage that, especially we have a lot of people that have kind of DIY. They've done it themselves forever. Some of them have decided, you know what, I need to spend, or a lot of times their spouse is saying, you're spending too much time. You can't wake up at 3 or 4 every morning and track markets. And so we encourage them, though, to say, hey, let's go ahead and if you're going to invest, especially if you want to take risky bets, that's great. Do so with Vegas money, number one. Like, you can lose it, right? You walk into a casino in Vegas, you better go in with what you expect to walk, not be able to lose and not walk out with.
No, that's a great, and that's one of our basic rules that we have is that, you never trade money. Like if you're going to speculative invest, right? We don't encourage that, because if you lose $2,000, just the multiple of compounding over time, that's like 50 grand, of your retirement money. Just, that's $2,000. Who cares, right? You have to think about what that $2,000 means in 30 years, right? It's a lot of money on a compounded basis. So it's not just $2,000, but this is the way we just think about money. But you should never invest in a stock that's speculative, as an example, to Danny's point, with money you wouldn't be willing to lose in Vegas. So in other words, if I'm not willing, like for me, I don't gamble, right? Because I don't like losing money.
Yeah.
So it would be $100, but maybe that's even painful.
It is.
But if you're willing to go throw $2,000 down on a blackjack table in Vegas, then that's your Vegas money, right? But if you're not willing to throw $10,000 down on Vegas, don't do it.
Well, and I'll give you an example. Yesterday, a client of mine, good friend, we were talking, and he said, I really want to short Bitcoin here. And I was like, okay, we kind of talked through it.
Yeah.
And his thoughts were that this was just, what's that?
He's going to make a lot of money.
Well, maybe, right? But the other caveat is that who's to say this doesn't go up to 120, 130? There's really, it's just it's a sentiment factor more than anything right now, and a supply and demand. So, that is the struggle on a lot of these things. And really there's just hey, I feel like this is way overdone. I'm very convicted in this. Well, great. But you have to understand how these work, especially in these inverse related contracts where they're buying futures contracts. It goes down. You're gonna have to make a heck of a lot more to get back to even and see this turn. And if it immediately goes down, you could be in trouble. So you have to be able to, if you're looking at beating the market, and I feel like that's everybody's goal. We want to beat the market. We want to beat the market. And that's great. But even if you just bought the S&P 500, you're still going to underperform just because of the small bit of fees that even an ETF has. Take SPY, for example. I don't know what those fees are exactly right in front of me, but I think they're like 0.1,
like
give or take.
Bips. Yeah, they're little.
Yeah. And so you're going to underperform just as a function of how that works. Also, as you've always talked about is, the market will take somebody out. It's no big deal. But if they take it out and it's down significantly in your portfolio, it looks a little bit different, right? So things I think that we have to consider and kind of level set is, okay, great. I want to beat the market. I want to really beat the market on the downside, protect assets, mitigate that risk. But on the upside, if we can still participate over longer periods of time, if you can reduce the amount of downside volatility, you're likely going to be much better off, especially like we're going back to that last article we talked about a bit ago, in those negative years. So when we're in distribution mode, that is when it really begins to erode our capital, as long as, as well as when capital markets decline. So, when we're thinking about this play money, I think that we have to think about it and, maybe compartmentalize it, put it aside, say, hey, these are the funds that I'm willing to be super aggressive with. I'm going out on a limb, things that maybe I just have a conviction in, or I like something, maybe more of the sentiment trading in a lot is ways, like stuff that we may not buy.
Sure. And again, we've seen this before, right?
Yeah.
And so here, Brent, bring up this chart. So this is what happens in markets like we're in. This is the Goldman Sachs meme stock basket versus the NASDAQ. The meme stock basket is basically Riot, blockchain. It's GameStop. It's those type of stocks.
Is MicroStrategy a meme stock now?
I would probably say it's in there. So, but this is kind of that speculative fervor in the markets that goes on. We've seen this before, by the way. We saw this in 2021, and by the end of 2022, that meme stock basket was almost bankrupt. It was a lot of those stocks were down 80, 90% in 2022. Here's another chart, same thing. This is the unprofitable tech stock index. So these are all the stocks in the NASDAQ that are non-profitable versus the NASDAQ. So we're not even investing in profitable companies. We're just chasing momentum at this point. And so, a couple of things here. You want to chase those stocks, it's fine. And look, after 30, 40 years of doing this business, I can tell you this always works out badly. I cannot tell you how many people, it's countless numbers of people that I've managed money for over the years, I've worked with over the years. Danny will tell you the same thing. And they always have these little stock trading baskets that, I'm going to trade these stocks over here. They do great for a while, and then the correction comes and they lose all their money. And then like, that didn't work out so well, so, I'm not going to do that again. And this happens repeatedly over and over time. And this is why individuals underperform the markets by a large margin over time frames, because they buy high, they sell low, emotionally they do all the wrong things. And this is why. So this article on Barron's, it's talking about this personal and financial coach. I would not hire this person to be my personal or financial coach, because she says she does invest the bulk of her money in ETFs, right? So she's going to track the index. That's fine. But she puts her speculative stock money in her Roth IRA.
Yeah, I found that interesting
That
as
is
well.
a terrible idea.
Yeah.
And why is it a terrible idea? Right? So the reason she does that is that she goes, well, if I make all this money, I don't have to pay any taxes on it. Yeah, that's true. You also can't write off any of your losses against your gains in the future. You give up all of your tax benefit of trading stocks. All your risk money should be in a taxable account, not an IRA. That should be your super safe money.
Well,
your Roth IRA should be a super safe portfolio that's just going to grow over time and generate those tax-free gains.
Well, hang on. Let's define super safe versus, because we still want growth.
No. I said super safe growth over time.
Yeah.
Right? So that puts your S&P 500 index in your Roth IRA.
Yeah, but I think most people, when they hear super safe, they're thinking treasuries, cash, CDs, and that's not what you mean. That's why I wanted you to clarify that.
Yeah. No. Put your let's put it your conservative portfolio, right? Your stock bond portfolio, your 60-40, 70-30, 80-20, whatever it is, or your S&P index fund if you're young. Put that in your Roth IRA.
You're not chasing the meme stocks.
All your risky bets, the stuff you're probably going to lose money on, put that in your taxable account.
Well, and that's a conversation we had yesterday as well. It's like, okay, well, you could buy it in the IRA, but here's the consequences, right? If it does go down, you're in trouble.
It's like putting real estate in an IRA.
Yeah,
a terrible idea.
I've never seen that work out well, and anybody that I've met who's done that, every time you ask them, they're like, man, that's one of my biggest regrets. But yeah, put that in a taxable account so you can offset. If you have something that's just a high flyer, it's a big winner, but you have something else that didn't do as well, offset those gains, use those to your advantage. And I do think you're really right on that, Lance, and I don't say that often, but the Roth IRA.
You better be glad we're still broadcasting on radio. When we come to YouTube, I'm going to tell you what I really think about your comments.
Oh, I can't wait. It's going to be great. So I know I've got this little safety net right now. You can't cuss me out.
Exactly. If we ever go to straight YouTube, man, it's going to be bad.
Oh man, that's great. That's why we won't.
You viewers, this is going to be an R-rated episode of the Real Investment Show.
But we do want growth in those Roths. So, I think that's a great thing that we want to make sure that we're putting funds there that we know will grow over time. Speculating, I think you can use to your advantage in a taxable account. Listen, you may hit a home run, but you're not going to hit a home run on everything that you have. I mean, we'll even look, there's years and we look to do tax loss harvesting. And it's a difficult time. This year's one of them, 2021, 2019. Those were years where we didn't have a lot that we could sell. But there's going to be times that you can take those losses, carry those forward. And so keep in mind, that you're looking at the bigger picture here from a taxation perspective. If we can have an asset that we think is going to do very well on a conservative basis, what I mean by conservative is that we're not investing in something that, we can't articulate an intrinsic value or, understand exactly what it's worth, and there may be times that, we're investing in some things right now, and Lance, correct me if I'm wrong, that, maybe they're super expensive, but they can also get a lot more expensive from where we're at.
Yep.
But those are things that you can still invest in based on, having a discipline. So understanding that, I think, certainly helps. We want that growth. Ideally, I want a ton of growth in the Roth IRA, but I don't want to speculate where, it goes down to nothing.
That's right.
That's not Vegas money.
That's correct.
That should be long-term money.
Well, and again, but this is, let's back this whole conversation
up. I'm not retiring off Vegas money.
Right. Well, let's back this whole conversation up real quick. We shouldn't even be having this conversation because this is not investing. This is speculation. And we have turned the market since 2000 because of E-Trade. That started the process along with a bunch of other online trading firms back in the late 1990s. We changed the market from an investing function, which was to grow our capital to outpace inflation over time, to this speculative get-rich-quick scheme. And it's not worked out well for most people.
I mean, look at the numbers. Look at how much people have in cash. It's
exactly.
Yeah.
So, all right, we'll come back, wrap up the show. Don't go away.
Get Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And welcome back to the show. All right, just getting ready to wrap up. So, like I said, look, the markets have changed dynamically since 2000. Just a good example, value stocks, right? Value stocks have been down 12 days in a row while the market's been going up. Nobody wants value stocks, and it's because we're in rebalancing right now. And again, value stocks have underperformed this year, so there's a lot of tax loss harvesting in that area. But nonetheless, value stocks have vastly underperformed the growth index this year. Value stocks have underperformed for about the last 15 years in the market. So, the whole point of investing, and going back to Benjamin Graham, kind of the great value investors of our time, the whole thesis behind investing is to buy stocks cheap, sell them expensive. That has not applied to the markets in the last 15, 20 years, because we've now just turned the entire market into a big giant casino. And it wasn't as bad coming out of the dot-com crash. That speculative fervor was vastly exacerbated following 2009, when everybody just stepped in, particularly the Fed, zero interest rates, round after round after round of QE, and we have just now distorted the markets. And this was an interesting thing. I had this conversation with Michael Pinto last Friday on a zero hedge debate, and his whole premise is that stocks are going to crash by 50%, the Fed's not going to come bail them out. That's bull hockey. Because we had a 35%, we had the perfect environment, right? So everybody's been calling for this 50% crash in the markets. We had the perfect environment for a 50 to 80% crash in the market in 2020. You shut down the entire economy, right? There was no earnings growth because nobody could work. So if there was ever a reason that you could have a 50 to 80% crash in the market, that was it. And you had a 35% decline that was immediately arrested by the Fed going $120 billion a month in QE, zero interest rates and everything. So if you don't think for a moment that if we get to another 20 or 30% decline, let's back it up even a little bit further real quick, Danny. 2018, September 2018, Fed, hey, we're nowhere near the neutral rate. We're going to keep hiking rates. Apply this to today's Fed meeting, right? We think that interest rates, we just need to halt here. That's great. They can say that today. They said that in September of 2018. 3 months later, 20% down in the market, the Fed goes, yeah, I think we're right on the neutral rate. We're good. And I think we could probably start thinking about cutting rates next year.
Well, it wasn't even then. It was from October to November.
Yeah.
They
2 months.
switched. And then it went down another 10%.
Exactly. And so if you don't think for a moment that if we're down 20, 25% and the banks are starting to get impaired by financial stress, that if you don't think the Fed's going to step in and start bailing it out, go reverse from QT to QE and start cutting rates more aggressively, you're out of your mind, because that's the new playbook right now.
Well, and what are the Fed's mandates, right? It's to keep inflation in line, which now their target's 2%, and employment.
That's their stated mandate.
Well, their stated mandate, correct. But then what is their real mandate is protect the banks.
Correct.
Yeah.
And they said that
they
said that very clearly in 2010. Bernanke in 2010 said, we're doing QE to spark consumer demand. We want asset prices to go up so people will feel better and start spending money in the economy.
Because, well, what happens when asset prices go up? Things are appreciating. The banks can lend more money.
Correct.
Make more money.
It stabilizes, more importantly, it stabilizes the collateral values on their balance sheets.
Correct.
Right.
Yeah. Well, because then you don't have all the margin calls. You don't have
Correct.
everything else that's occurring, that all of a sudden the banks are on the hook for things that people can't make those ends meet. And that's going to be the challenge here moving forward, is that, with a conflicting kind of mandate, more or less, and not even that, inflation and unemployment, those are kind of conflicting as well.
Yes. And by the way, Pete, bull hockey is a technical term when you can't use the real word on a PG-rated show.
Oh, that's malarkey.
Yeah. Again, if we ever happen to go to full YouTube,
I can't wait.
This will not be a show for children.
I'm going to have my thesaurus out for you, Lance.
Exactly. I don't know why you're bringing a small dinosaur, but okay, why? That's fine.
My grandfather back in the day used to, every day, he taught me, he's like, hey, every day just pull up your dictionary and just open it up and learn a new word. I was like, man, that's genius. You can still do it. So now there's an app for that. But, so you have to lug that dinosaur around. My goal used to be to use a new word every show just to get you off base a little bit. I need to do that again. It's been a while.
It's been great. When I was growing up, every day my dad and I would sit down and read the encyclopedia.
Yeah.
And so, my kids are always like, Dad, why do you know the most useless random stuff? It's because I read the encyclopedia. We literally read the entire Britannica encyclopedias growing up, A to Z.
Well, do you still have those?
I wish I did. I wish I still had those. They're worth money.
Oh, yeah, no doubt. We have some world books and some encyclopedias. So if you ever want to see what really happened versus what the narrative is today.
Yeah. Oh, vastly
big difference.
Absolutely. The rewrite of history has been absolutely phenomenal.
And it's been so slow, or maybe not slow, but it's happened like under the radar, and nobody's questioned it.
Yeah. Well, again, if you put it out on the internet, it must be true.
Yeah.
Right.
That is true.
All right, Danny, we got a couple of minutes here. Where do you want to wrap up?
Well, so this is that time of year everybody's talking about Roth conversions, and we've talked about, a little bit on where should funds grow. Ideally in a Roth, that's great because you're going to take those funds out. It's not going to impact a number of other things that we have to be considering in retirement, especially in distribution age. And when we get to that required minimum distribution age at 73, which will go up to 75 in 2033. So things that we have to be considering is kind of looking at long term. And I think a challenge right now is looking at a lot of these analysis is, we have people in house that do this, and looking at it and they say, well, it doesn't make a whole lot of sense for me until I reach this age, and that may be 83, 84, 85. And really depending on your age, if you're doing it at a much younger age, you're going to get the benefit of it sooner. If you're doing it at later, it's going to take a little bit longer for, you to pay the taxes, to have those funds grow. But we're making a lot of assumptions and hypotheticals and things that we frankly don't know. We don't know where taxes will be. We don't know if they're going to change the IRMA, the amount of a premium surcharge on your Medicare premiums. We don't know what they're going to do with Social Security from a taxation perspective. There's bills right now in the House to potentially eliminate that, but then increase the payroll tax. There's a lot of different things that are occurring all at once and that will continue over a longer period of time. right now, we currently believe that we have a much higher chance that we're going to see the Tax Cuts and Jobs Act extended or made permanent. It's much higher than what you had at Harris administration. But nothing's set in stone. That doesn't mean it's going to happen. We currently have this tax code for this end of this year, right? So 2 weeks in a year. And hopefully they can make it permanent or do something that's going to, help everybody else, right? And so by lowering taxes, I think the chances of them lowering are much smaller. I know they've talked about, eliminating income taxes and doing tariffs. That's going to be really difficult. I think that these lobbyists and everybody else and politicians in general like the taxes because that gives them something to argue about to take our attention away from other things. But the problem here is that we have to think about what if these things go differently. And I've explained this before, the way I want you guys to think about a retirement account. So if we have a pre-tax retirement account, you need to think about this as a business, but it's a unique business because you have a partner and you don't control how much they own. So if Lance and I go and start, Lance, Brent and I go start a business and we can say, hey, we're all going to own 33.3%. No big deal. It's set in stone. We know exactly what that is. But your partnership with Uncle Sam is that you can say, well, right now they own 20, but next year they could own 30. And now we're talking about how do you best protect those funds from a longevity perspective to reduce the other potential income taxes that you have, not just your effective income tax, but also the premiums associated with Medicare when you get older, if you're not 65 yet, the Social Security taxation aspect, all the other little ways that they can means test you. They're doing that now, by the way. A lot of people say, we don't have means testing. That can come. Well, it could. So these are things that we need to start thinking about. Also, the longevity of funds. How long do you have with these funds? When does it make the most sense? If taxes go up in your lifetime, would it be better to have some in an area that you can draw down from that you're not going to have to pay income taxes on? You can have that substantial growth, and it's not going to impact any of these other types of taxation. And so the other caveat is Secure Act changed non-spousal beneficiaries. You have to take those distributions within a 10-year time frame now. If somebody's already taken their RMD, you have to take RMDs years 1 through 10. If you don't, if they had not, you have to take it all out by year 10. And if those funds are in a Roth, you still have to take the funds out, but your heirs are not paying income taxes. Who knows where taxes will be in the future? Look, we're hearing all this talk about, the Department of Government Efficiency. They're going to reduce all this debt. Yeah, they're probably going to reduce some, but we're still spending a lot. And if we can't get this under control, they're going to have to come back for your funds to basically produce that revenue that they need to spend. So keep that in mind that, we're looking and we're factoring in a lot of different things. And these are things you all need to be considering. For some of you, it may not matter. You may say, hey, it doesn't make sense. And that's great. It's not for everybody. It's not a one size fits all. Make sure you're doing the analysis. And you know what? If you don't want to do it, don't do it. But I think there can be benefit further in life.
And just as your friendly reminder here, it is exactly 7 days to Christmas. So we've already done all of our shopping. We're giving our kids batteries this year with a note that says no gift included.
Hey, and if you want to give somebody a gift, we will be doing our Financial Summit, Economic Summit on January 18th. Go to realinvestmentadvice.com. Sign up there. Adam Taggart will be here. Michael Leibowitz, Lance, Richard Rosso, and myself. We'd love to see you guys out, meet everybody in person.
Danny is always so serious.
I'm being serious. I like to meet people.
All right, we'll see you back here tomorrow with Michael Leibowitz. Talk all about Fed tomorrow. See you then.